Hi everyone, thank you for joining me for this 1-hour online session for our finance course. During this session, we're going to touch on a few points that are a review from last week, as well as a review from your readings that were assigned as part of your homework. And we're also going to introduce some new concepts that are going to lead into our classwork on Friday together. So in particular, what we're going to be looking at is a quick review of the accounting cycle and then that in-class activity we did together on Friday. We're then going to look at some gap measures. In particular, we're going to look at two commonly accepted methods of reporting and narrow that down to the one that we would typically use within a business structure. Then we're also going to define what the IASB and the IFRS are, and also look at what the relationship between the two is. So how are they related? And finally, what we're going to wrap up with is we're going to take a look at the most common business structure that typically exists in corporations as well as large businesses. But then we're going to focus in on the two key financial roles, which is what one of your final activities will be for this online class, where you'll do a roles and responsibility matchup to differentiate between those two key roles within the organizational structure. So let's go ahead and get started. So this is our accounting cycle. If you remember back to Friday, we started with analyzing those business transactions, and that really comes down to step number 1. Business transactions happen. You buy things, you sell things, you perform services, you earn money, you spend money, right? Things happen, and those are your business transactions. Along with those transactions, usually there's some sort of documentation that comes with it, which is really step 2. You issue receipts, you issue invoices, you receive receipts for things you have to pay for, or you're given invoices for things that you owe money for. You have employees who submit timesheets who need to be paid, right? There's that documentation portion that happens within the business cycle. From there, we end up going into step 3, where we're recording these transactions in some way, shape, or form. Now, if you remember back to your accounting last winter, that can take place in a number of different forms. In class on Friday, we recorded using the expanded accounting equation. And you also did last winter, you learned how to record using T accounts, and you also learned how to record using a journal and that journalizing process. Right, so that's step 3. It's the actual recording process of those business transactions and the documentation that you've either received or given out. That moves us into step 4. Step 4, that point, we then need to transfer the information from our journals over and post them to our ledger accounts. Right? The ledger accounts are the actual accounts themselves that have been affected by those business transactions that have happened. Now the journal, the original book of entry, would have been the first place of recording, and then we would post from there to the ledger account. And then that leads us to step number 5, which is the process of what we would call closing our books. And when we close the books down for a period of time, what we mean is that we are actually taking a summative total, right, or the balance of each of those individual accounts, and taking that balance and producing that trial balance, which is the record of every single one of our T accounts and what is currently sitting in each of those accounts. And that's what we did in class on Friday. We took everything, or those business transactions, right from step 1 all the way through to step 5 of the accounting cycle itself. We then took it one step further, right? But these are the original 5 steps of the accounting cycle. I guess you could say the 6th step would be the step where we finished completing this business cycle or this accounting cycle by creating our formal financial statements. And it's that difference between step 1 to 5 and step 6 that really makes the difference between what is it that we refer to when we talk about bookkeeping and what is it that we refer to when we talk about accounting. Technically, bookkeeping is steps 1 through 5. Once you get your recording of your business transactions down, to the end of that trial balance and all of your accounts balance, at that point, the role of the bookkeeper has finished. Right? The role of accounting is to take that information and prepare the formal financial statements. And from that preparation of those formal financial statements, to be able to extrapolate from that the meaning of what is actually going on within your business. So they really are important documents, and it's a fine line between bookkeeping and accounting. They're very similar functions, right? But the accounting is really focused on the after effect of having completed the accounting cycle already. Okay, now if you want to read up a little bit more about the accounting cycle, a lot of this information has been drawn from Chapter 2, starting on page 40. So if you're looking at it in your e-textbook, you can actually open up the search function in Texidium, put the page number in as page 40, and that will leap you straight to the page where it starts the discussion on the accounting cycle, the bookkeeping, and the difference between bookkeeping and accounting if you'd like some further information on that. Okay, moving on. GAAP methods of reporting. Who remembers what GAAP stands for? Right? Generally accepted accounting principles. And typically, these GAAP measures, these are generally accepted practices that happen within countries, individual countries themselves. And every country has its own sort of standard of what they consider generally accepted accounting practices and procedures that they are required to follow. This is going to lead a little bit into the discussion about IASB and the IFRS, which is coming up shortly, right? But over the years, we've been finding that countries are getting closer and closer together with their GAAPs, with some slight variances, which has required the need for more globalized accepted standards. Okay, so hold that thought. We're going to come back to it. But for now, let's take a look specifically in Canada about the two most common methods of reporting. Okay, and this is actually a pretty common fundamental gap that exists in most countries. So the first for the methods of reporting is a cash method. The second is the accrual method. And you really have a choice of one or the other. You're not going to be running a set of books that uses both. So the key difference between the two is when does the recording process happen? I mean, business transactions are going to happen in stage one regardless in step one. Right? You're going to get your documentation of it regardless in step two. But when do we actually record the fact that these transactions have happened? And that's what differentiates these two methods of reporting. In your cash method, we only record it when the actual cash is either received or it's dispensed. One or the other. Okay? So it doesn't matter if we sell something to somebody, give them the product, and let's say we did that on Monday, but we don't actually get the cash until Friday. In that case, we would not record the transaction as having happened until the day the cash was received, which would mean not until Friday, even though we actually technically sold it back on Monday. That's a key difference. If we look at the accrual method, this is the method that most of us are most familiar with because this is the method that we taught you back in level 1 accounting. So in your accrual method, in this case, we record revenue when goods are sold, right, or services are sold, regardless of whether the cash has been received or not. So this is why we end up with an in this case, an accounts receivable, because we need a way to track, did we either get paid by cash or did we get the promise to be paid in the future? So it creates that need for tracking the fact that people owe us money. So back to our similar case where we sold the product on the Monday, but we don't get the actual cash for it until Friday. In the accrual method, we would record it the moment the transaction happened, which was the Monday that we sold that particular product. Okay? And that's the same for expenses. It works both ways. Right? So we looked at the revenue side from the sales side, but it's the same for expenses. We record the expense having occurred the moment it happens, regardless of whether we bought it using cash or whether we bought it with a promise to pay for it in the future, such as we bought it on credit. Okay? In truth, the accrual method is the most common method used. Very few people work on a cash basis when it comes to their account reporting, because people want to know who owes them money, and they need a way to track that in order to ensure that they actually get the cash that they are owed. So hence method number 2 of our GAAP methods for reporting, the accrual method is the most commonly used method. And that's the one that we're going to carry forward from here on out. So that leads us to a discussion about the IASB and the IFRS. All right, with these two, the IASB, that stands for the International Accounting Standards Board. The IFRS are the International Financial Reporting Standards. Now, as it turns out, the IFRSs are actually issued by the IASB. So that's how they're related. Think of IASB as being the actual governing board, and what their responsibility for is they've actually been tasked with a purpose to improve and reinforce global standards for accounting practices. And it's becoming more and more important every year, based on the fact that our world is getting smaller with this whole globalization movement, and many companies, both small and large, are operating across borders, if not across the Atlantic, across the Pacific, in multiple countries at the same time. So it's becoming extremely important that we are reporting our documents in the same manner. And this is where the image of the apple and the orange on the scale together come hand in hand, is if we're comparing financial statements between two different companies, we want to make sure that we're comparing the same documentation that's based on the same reporting methods, so that one, for example, is not being based on a cash basis of reporting versus another being based on that accrual method. We need to make sure that when we're comparing documents, we're actually comparing apples to apples and oranges to oranges, the same thing. Yes, they can both be fruit, right? They're still in the same family, but they're not the same fruit. So we need to make sure apples to apples, oranges to oranges. And that's the task that the IASB has been given to drive within this global economy. So that's their purpose. So they create these IFRSs, and currently, I think the last count, there was about 41 of them in practice, and those have become the financial reporting standards that are now internationally accepted. And most countries, and I stress most, not all, have signed on to following these IFRSs. Canada being one of those. The US being one exception. So there we go. Our neighbor to the south likes to continue to be different. But it is important to understand that relationship, that it is the IASB that actually creates, promotes, governs, and reinforces the IFRSs, which are the International Financial Reporting Standards. Now, to find out a little bit more about these, you can actually follow up on it in Chapter 1, starting on page 27. So again, you can go to your Texidium and you can use your search function to search that page number, and it'll leap you straight there. Okay, so that was the two acronyms I wanted to make sure to touch base on. And let's head on now to our structure. Okay, this is an authority structure which is typical of most large businesses. Now, again, it's typical. It does expand and it can contract based on the number of employees and based on, its particular structure, but this is common of what you'd see. Most people, when they think of who or what is the top of a company, the person who is most in charge, automatically think of the CEO as being that person who's in charge, right? The chief executive officer. This sometimes is referred to as the president, as being the head of the company. So, in fact, there's a slight difference, because there is somebody else that officer is going to need to report to, and that's the board of directors. The board of directors is often made up of a representation of the stakeholders, or in most cases, the stockholders of the company. They're an elected board that represents all of those people who have a stake within the company itself. And a chief executive officer or a president is going to have to report to them. But functionally, as a sort of administrator or as a figurehead of a company, that truly is the CEO. Now, under them, you're going to have a CFO, which stands for a Chief Financial Officer. And typically, you're going to have a Vice President, which could be expanded into a number of different roles. We could have a Vice President of Marketing, a Vice President of Production. We could have a Vice President of Human Resources. We could keep going with this, and we can even add a Vice President of Sales. We could have a Vice President of Research and Development. So your vice presidents are kind of like the head of their each individual departments. And under those heads of each individual departments, they're going to have somebody reporting to them who is typically their operating managers, who ensure that their department and their function within the company is actually functioning properly. For us, our concern is this area over here. We're concerned about who and what are the roles and responsibilities that report to the Chief Financial Officer. In particular, we're looking at the controller and we're looking at the treasurer. And they each have significant uniqueness to their role within the company structure. And they each do something different that adds to the management of the finances with a company. So to explore more about this, we're going to have a little roles and responsibility activity to do to look at a number of different responsibilities that would fall under a CFO and see what would the controller look after and what would the treasurer look after. So in closing, and I kept it close to the 15-minute mark. We're a little bit over, but I'm coming in shy of the 20-minute mark, so thanks for bearing with me. But in closing, we have 2 activities to complete. You have a crossword puzzle, which is a review based on the readings of chapter 1 and 2 from last week, as well as from this podcast. And then you have that roles and responsibility matchup exercise. So those links are within this same learning unit, and you'll just have to close the podcast and use the links provided within the learning activities to take you to each of these exercises, just to help reinforce the information that we've discussed together in class. Make sure to complete this before our next class, which is on Friday, and I look forward to seeing you all at that time. Thanks for joining me in this online course, and any questions that you have, please feel free to email me or save them for Friday, and we'll discuss them at that time.